Hi, this is Jeffrey Kurt, Kurt Financial Group. Today is Wednesday, August 19, 2026. So I wanted to cover some interest rates today and why they matter. It's kind of a quiet day in the market. So those U.S. stocks have been down 3 days in a row, bouncing back so far today on Wednesday. And Asia, kind of down, again, Kospi, the South Korean index, that was down 5% last night. So again, some of the things we've been talking about, but I had a conversation with someone just on the importance of interest rates, and I thought it might be a good overview to talk about today. Why do interest rates matter? And interest rates move around, and they are largely set by supply and demand in the marketplace. Yes, the Federal Reserve has control over the overnight interest rate, but it's just a short term and one interest rate. Yes, the Federal Reserve also has other tools of money supply and repo agreements and like that. So they do have an influence, but largely, the longer term interest rates are set by supply and demand. And as I've been saying, rates have been going up. So on the consumer side, the individual side, that translates into higher mortgage rates, higher credit card rates, higher auto loan rates, and other things that we borrow for. Those interest rates go up. That means potentially and theoretically less money for consumption, which is an important part of the economy. On the business side, higher interest rates again means higher borrowing costs for either bank loans or public bonds that are sold to fund capital projects, mergers and acquisitions and different things like that. So these higher interest rates matter, for the businesses too, because if you're paying more in interest, there's less left over for the bottom line, which is one of the things the stock market really cares about is profits, sales and profits, and are they growing? And with higher interest rates, that's just another obstacle for growth of earnings and like that. And then finally, in the government, we've got huge deficits and growing deficits, and higher interest rates are now meaning that we're spending more and more tax dollars or borrowed dollars from the government to pay the finance the debt and also just pay the interest. So we're not reducing the debt at all. The debt keeps growing, and now with the higher interest rates, that is meaning more money going to interest payments for the federal government. And again, we've been doing this for a long time on the federal government deficits, and at some point, we're at a record high now, and at some point, there seems to be you've got to have some sort of reconciliation, and that may again crowd out the bond market, that the federal government is borrowing so much that the interest rates keep going up, and it's kind of circular that higher interest rates means you're paying more of interest, and then you need to borrow more for that and like that, and that's not long-term sustainable. I don't know when that would be a inflection point or a critical point, but again, I had this conversation, wanted to just pass along and hopefully relate where the hip bone's connected to the knee bone type of thing, how interest rates do matter in the economy and in our lives. Send along any questions or comments on this or any other topic. Thank you for listening, and we'll be back on Friday. Goodbye.